Not long ago, New Zealand was hailed as an economic miracle. World-class reforms, booming exports, and a currency envied across the Pacific. But in 2025, it faces shrinking GDP, surging debt, and families struggling with prices rising twice as fast as wages. The story of why New Zealand is going broke isn't just about lost prosperity. It's about how a nation built on stability unraveled. What caused New Zealand's sudden descent, and could it happen elsewhere? In July 1984, a new government swept into power in Wellington with a mandate to overhaul New Zealand's tightly controlled economy. Led by Finance Minister Roger Douglas, officials at the Treasury set out to dismantle decades of protectionism. Within months, the New Zealand dollar was floated in March 1985, ending its fixed exchange rate and exposing the currency to global markets for the first time. That same year, the budget introduced sweeping tariff reductions. Average rates on manufactured goods dropped by 20%, with further annual cuts locked in through the late 1980s. By October 1988, the last major import licensing requirements for manufactured goods were abolished. The result was a rapid transition to a tariff-only system, with average manufacturing tariffs falling from 28% to below 18% by July of that year. Over the next 3 years, annual reductions continued, targeting near-complete tariff removal by 1995. For New Zealand businesses and consumers, foreign goods flooded in, prices fell, and competition intensified almost overnight. Privatization quickly followed. State-owned enterprises were restructured into commercial entities, then sold off in a wave of transactions. New Zealand Steel was sold in 1987 for $327 million. Petrocorp, the nation's oil and gas company, went for $801 million in 1988. The Bank of New Zealand, Air New Zealand, and Postbank all changed hands between 1989 and 1990, with the largest single sale, Telecom New Zealand, fetching $4.25 billion in 1990. Most buyers were international investors or consortia, bringing in much-needed foreign capital. Proceeds from these sales were used to pay down government debt and reinforce fiscal discipline. The immediate effects were dramatic. GDP growth accelerated through the 1990s. Unemployment fell below 5% by the end of the decade, and the New Zealand dollar gained strength. Proponents hailed the reforms as a blueprint for economic modernization, pointing to increased efficiency and a more competitive export sector. For a time, New Zealand stood as a model of free market transformation, its economy revitalized by the scale and speed of liberalization. By the early 2000s, the pace of New Zealand's economic transformation had slowed. What once looked like a textbook recovery began to reveal new weaknesses beneath the surface. Productivity growth, which had surged in the 1990s, hit a plateau. According to the OECD, New Zealand's output per hour worked stalled well below the average for advanced economies, and the gap only widened as the decade went on. Economists and Treasury officials warned that the country's newfound prosperity was masking a deeper problem. Too much of the economy was now concentrated in a handful of sectors. Property investment became a national obsession. A growing share of household wealth and bank lending poured into real estate, especially in Auckland and other urban centers. By 2004, housing accounted for more than half of all new bank lending. Rising house prices fueled a sense of easy wealth, but they also drew capital away from more productive businesses. At the same time, the dairy industry expanded rapidly, driven by soaring demand from China. Fonterra, the country's dairy giant, grew to represent nearly a fifth of all export earnings. Tourism also boomed, with international arrivals tripling between 1995 and 2019, making it one of the top sources of foreign income. For a while, these three pillars, property, dairy, and tourism, seemed to offer a stable foundation. But economic commentators in Wellington and abroad began to voice concern. The OECD noted in its 2009 and 2013 surveys that New Zealand's growth model was unusually reliant on volatile external demand and asset prices. Productivity gains lagged behind other developed countries, and income growth for most workers slowed. By the late 2010s, wage growth had decoupled from the country's headline GDP numbers, and household debt had quietly climbed to record highs. Underneath the headline success, the economy's resilience was eroding. Too much depended on the next property boom, the next surge in Chinese dairy demand, or another record tourism season. The warning signs were clear to those who looked closely. New Zealand's miracle had become a balancing act, one that could not last forever. New Zealand households now carry some of the heaviest debt loads in the developed world. By early 2025, the average household owed nearly 170% of its disposable income, a ratio that has doubled since the 1990s. Most of this debt is tied to mortgages, concentrated in cities like Auckland, where property values soared during the last boom. Over $218 billion is now outstanding nationwide, with Auckland alone accounting for more than a third of all mortgage balances. The structure of these loans has made the situation more precarious. During the pandemic, banks issued a flood of fixed-rate mortgages at historically low rates, many below 3%. But these deals were short-term. Starting in mid-2023, about 60% of all home loans began resetting to new rates above 6%. For thousands of families, this meant monthly payments jumped by hundreds of dollars almost overnight. Bank notices warning of higher repayments landed in mailboxes across the country. Reports from mortgage brokers and insolvency advisors describe a steady rise in arrears, missed payments, and calls for help. In one Auckland suburb, a family who bought their first home in 2021 now spends more than half their income on the mortgage alone. Essentials like groceries and heating are being cut to keep up with the bank. Stories like this have become common, especially among recent buyers and those with little equity. The financial strain is visible in food bank queues and in the growing number of forced sales. These pressures are building before any full-scale fall in property values, leaving households exposed as the next stage of the downturn approaches. In early 2022, the median house price in Auckland stood at more than 10 times the typical household income. By mid-2025, prices in some suburbs had fallen by over 20%, wiping out years of paper gains for recent buyers. The downturn spread quickly from homeowners to the construction sector. Building consents for new homes, once a symbol of booming demand, plunged by 30% year-on-year. Developers who had expanded rapidly during the upswing now faced a wall of canceled contracts and unsold inventory. Steel Works Group, a major player in multi-unit developments, entered liquidation, leaving thousands of unfinished homes and unpaid subcontractors. Court documents detail a collapse that rippled through the industry. 16,000 construction jobs disappeared in just 12 months. For many workers, redundancy notices arrived with little warning, pushing skilled tradespeople and apprentices out of work. Some found themselves forced to leave the industry altogether, while others looked across the Tasman for steadier prospects. The slowdown extended beyond building sites, squeezing suppliers and small businesses that had relied on the property boom. What had once been a driver of national prosperity now threatened to undermine household wealth and community stability, as the fallout from falling prices and mass layoffs spread through the economy. Imported goods now cost more than ever for New Zealanders. The New Zealand dollar has fallen to multi-year lows against the US dollar and other major currencies, making everything from electronics to basic groceries more expensive. Since 2022, the NZD has lost over 15% of its value, eroding the spending power of households already stretched by rising debt. Imported fuel and machinery have become a particular pain point for businesses, driving up transport and production costs across the economy. Energy bills have added to the squeeze. While there hasn't been a repeat of the 2021 hydro crisis, household electricity prices have crept up steadily, averaging a 7 to 9% increase over 2 years. The country's heavy reliance on hydro and imported fuels leaves it vulnerable to global price swings and local supply constraints. In winter 2024, short-term supply issues nudged wholesale power prices higher. But most families felt the pinch through slow, relentless bill inflation rather than a sudden shock. The real blow has come from inflation. Consumer prices peaked at 7.3% in 2022, the highest level in more than 3 decades. Wages failed to keep up. For many, paychecks now buy less food, less fuel, and fewer essentials than just a few years ago. The weak currency and energy costs have turned every trip to the supermarket or petrol station into a reminder of how quickly the cost of living can spiral when a small, import-dependent country loses control of its own prices. In March 2020, as the world shut its borders and global markets convulsed, the Reserve Bank of New Zealand launched its most ambitious intervention in history. Over the next 18 months, the central bank created $53 billion through large-scale asset purchases, buying up government bonds to flood the financial system with cheap money. The official cash rate, or OCR, was slashed to just 0.25%, its lowest level ever. The aim was to keep credit flowing, prevent a collapse in confidence, and soften the blow of pandemic lockdowns. Bank executives and policymakers spoke publicly of avoiding a repeat of the 2008 crisis, and for a while, the strategy appeared to work. Mortgage rates fell below 3%, fueling a surge in borrowing and another wild run-up in house prices. Investors and households alike rushed to lock in fixed-rate deals, convinced that low rates would last. But by late 2021, the mood inside the Reserve Bank had changed. Internal minutes and leaked emails reveal growing anxiety about runaway asset prices and the risk of inflation spiraling out of control. In October, the board voted to begin a series of sharp rate hikes. The OCR rose from 0.25% to 5.5% in less than 3 years, one of the fastest tightening cycles in the developed world. For borrowers, the effect was immediate and painful. As fixed-rate mortgages expired, repayments doubled or even tripled. Food banks and insolvency advisors reported a wave of new clients. Critics accused the central bank of acting too late, warning that the rapid policy reversal created a whiplash effect. Easy money had inflated the bubble, and now higher rates were bursting it. The Reserve Bank's own balance sheet, swollen by its bond buying spree, became a symbol of how quickly monetary policy could swing from stimulus to restraint. The fallout from these moves would soon ripple through every corner of the economy. More than 30% of New Zealand's total exports now flow to China, with dairy dominating the trade ledger. Fonterra, the country's largest exporter, sends nearly a fifth of all national export value to Chinese buyers each year. Board minutes from 2023 and 2024 reveal growing concern about falling demand and price negotiations that leave little room for error. When China's appetite for dairy softened in 2022, Fonterra's payout to farmers dropped sharply. Rural incomes contracted, and entire communities cut back on spending. The country's dependence on a single buyer for so much of its export revenue has become a risk that's impossible to ignore. Tax policy has offered little insulation. Unlike most advanced economies, New Zealand has no broad-based capital gains tax. While the bright line test taxes some property profits, most asset gains remain untaxed. This gap has fueled speculative investment and left the government with a narrow tax base, heavily reliant on income and consumption taxes. During boom years, this approach seemed sustainable. In a downturn, it limits the state's ability to cushion shocks or fund new initiatives. Wages have stagnated even as the cost of living has soared. Since 2018, the gap between productivity and average earnings has widened. OECD data shows that New Zealand's wage growth has lagged behind both inflation and productivity gains, leaving many workers with less purchasing power each year. Economists warn that if this trend continues, the country risks following the path of Japan's lost decade, rising output but flat or falling real incomes. Other small economies have already faced similar crises. Ireland's property-fueled boom ended with a banking collapse and years of austerity. Iceland's currency crash sent import prices skyrocketing. In both cases, heavy reliance on a few sectors magnified the pain. For New Zealand, the warning signs are clear. Structural vulnerabilities run deeper than any single policy misstep. Treasury analysts now track a set of hard numbers that define the country's economic risk profile. Growth forecasts have been revised downward again. GDP per capita is down 4% since mid-2023, and the economy shrank another 0.9% in the June 2025 quarter. The jobless rate climbed to 5.2% nationwide, with underutilization, people unable to find enough work, reaching 12.8%. These figures are more than statistical blips. They serve as the new thresholds for official alarm. Business failures are accelerating. In the first half of 2025 alone, 1,270 companies closed their doors, a 12% jump from the previous year. Construction, retail, and hospitality are the hardest hit, each reporting waves of redundancies and shuttered sites. The risk map drawn up by Treasury sets out clear trigger points. If unemployment rises above 6%, or if business closures keep climbing, support programs and fiscal interventions will be forced back onto the table. Forecasters warn that even a mild recession carries the risk of further credit downgrades and rising debt service costs. If growth stays negative and job losses mount, New Zealand could tip into a deeper contraction, echoing the property-led busts seen in Ireland or Spain. For now, the scenario remains uncertain. Each new data release is watched for signs that the economy might stabilize, or whether another round of layoffs and closures is about to begin. On the streets of Auckland and Christchurch, the economic downturn is measured in more than statistics. A growing number of families now live in cars, garages, or crowded emergency motels, unable to secure stable housing. Recent NGO surveys estimate that 2.3% of New Zealanders are experiencing severe housing deprivation, a figure that has doubled since 2018. In Auckland alone, rough sleeping has surged by 90% over the past year, as mortgage defaults and rising rents push more people out of the formal housing market. This pressure extends far beyond the homeless. Skilled workers, once the backbone of the construction and healthcare sectors, are leaving the country in record numbers. Net migration to Australia has climbed sharply since 2023, with exit interviews from nurses, electricians, and teachers citing stagnant wages and soaring living costs as the main reasons for departure. Recruiters report a wave of young professionals and tradespeople seeking better prospects across the Tasman, leaving critical shortages in hospitals, schools, and building sites at home. Tourism, once a pillar of the national economy, has yet to recover. Industry revenue remains well below pre-pandemic levels, with international arrivals lagging by over 30%. Closed hotels and shuttered tour operators dot the landscape, while small towns dependent on visitor spending face shrinking local budgets and rising unemployment. For many, these trends are not just economic data, they are daily realities. The social fabric is stretched thin, and the warning signs are visible to anyone willing to look. New Zealand's crisis is no longer abstract. It is a matter of lost homes, lost talent, and lost confidence, with ripple effects that reach far beyond its shores. In the past year, New Zealand's per capita GDP has fallen by over 2%, with household debt peaking at 170% of income and national unemployment reaching 5.2%. The roots of this crisis trace back to reforms that once made New Zealand a model economy, yet also left it exposed to housing bubbles, reliance on a few export markets, and persistent wage stagnation. Documents from the Treasury and Reserve Bank show a cycle of stimulus and tightening that magnified both asset inflation and household risk. Despite clear evidence of policy missteps and structural weaknesses, full details on future government plans and potential trade deals remain undisclosed. What is certain, New Zealand's economic challenges are not unique. The data shows how quickly stability can erode when growth depends on debt and speculation. For New Zealand, and other developed nations, the evidence stands as a warning. Economic resilience cannot be built on borrowed time.